The step up in cost basis at death could be going away. What's that even mean? Guys, this is huge and could actually be a kind of one of the two components of inheritance taxes going up significantly. Let me explain coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Well, I mean, yeah, I suppose still smash the thumbs up button for this video, but you're not going to like the content. That's right. In the American Families Plan, which is, it's hard to call these things a stimulus plan now. It's more of an economic plan that was announced by the White House last week. And this one targeting families. I did a video about it just a couple days ago. So if you haven't checked out those details, please do so. Lots of different tax law changes and so on, but designed to provide benefits to families. So paid leave and free preschool and free community college for the first 2 years, and you know, nothing's free. It's reallocating tax dollars, so I just want you to know that. And expanding the child tax credit and providing for benefits for child care, all sorts of things, okay? But within that plan, $1.8 trillion plan, how are you gonna pay for it? And obviously there'd be lots of borrowing and all that stuff. Well, we're kind of used to that, but the other part of paying for it was some tax increases that they talked about. And there's one that shocked me, and that is getting rid of the step up in cost basis that many, many people rely on for simplicity when someone is passing and transferring wealth to another generation, but then also for tax planning, just being aware that, listen, there's a step up in cost basis, so therefore don't do anything right now or do this right now because of these rules. Well, within the American Families Plan, if the plan is passed and becomes law, that goes away. Okay, so what does this mean? If you're saving money up into your 401k, IRA, Roth IRA, those tax shelters, they don't get a step up in cost basis. Whether when you pull the money out, those rules of those accounts, that governs how it's taxed, okay? The Roth IRA withdrawals would be tax-free. IRA or 401k traditional, those sorts of accounts, you withdraw those dollars and they're taxable. But what if you're saving up money outside of a tax shelter, outside of 401k, Roth IRA, that sort of thing? What if you're just have your house, or what if you've got an investment account, or someone has, your parents had some stock that they held outside of those tax shelters? Well, right now, if they bought it here, okay, if they bought it at this level, and because of market value appreciation, it's now been moving around and it's now worth this. If that person sells that investment, they paid this, it's now worth this, the difference between these two, that's a long-term capital gain, as long as they held it for 12 months or more, okay? That's a long-term capital gain, taxed at long-term capital gains rates, which right now are either 0%, 15%, 20%, plus some additional taxes on top of that if they qualify to you, okay? But if you bought something for this, your house or an investment or whatever, and it's moved around in value and it's now worth this, and instead of selling it, you pass away and your beneficiary inherits this investment, okay? They're not forced to sell it at that time. They can continue holding it, but their cost basis, instead of it being this, their cost basis is now the value at the date that they received it, the date of your death, okay? So that's the step up in cost basis. And now, if they receive it right here, and then they sell it immediately, there's no capital gain, okay? If they receive it right here, and then they hold it for another 5 years, 10 years, whatever, and the gain, and it grows to this, now their capital gain is only that. Or if they hold it, and then the investment does this, they've got a capital loss that they can deduct, okay? So that's how the step up in cost basis works. And so it does a couple of things. It really simplifies passing assets from one generation to another, because you don't have to track the cost basis and all of that stuff that is typically very, very hard and cumbersome for people to do. So it makes it very easy. And plus, while you're grieving, if you receive an inheritance, there's always this, well, that's wonderful. I wonder what I'm going to have to pay in taxes. And this step up in cost basis makes that really simple. But then obviously, of course, knowing this rule that's been around for a long time, knowing this rule, you can plan for that. So for example, if I'm meeting with someone and they're in their late 80s and they've got an investment account that has a cost basis of $300,000, but a value of $500,000, meaning there's $200,000 of gain in there, I'm going to tell them, well, if you don't need to sell it, don't sell it. Okay, just hold on to it, because when you pass away and your beneficiaries inherit it, they will not have that $200,000 of capital gain. Their cost basis will move from $300,000 up to whatever the account value is at that time. So you'll be able to avoid those long-term capital gains. So that's how it works. That's the step up in cost basis. Now, within the American Families Plan, one of the proposals to pay for this, one of the sneaky tax increases is no more step up in cost basis. None. Okay? And it's not just for privileged individuals or if you have high income, it's no more, that the way I read it, and there's still obviously going to be lots of debate as to whether this thing becomes law in its current form anyway, but there's not a ton of details. But the way I'm reading this and the way many other financial professionals are reading what's been proposed by the White House is that step up in cost basis would go away, and it would be replaced by realizing those capital gains at that moment, and each person is allowed to exclude $1 million of capital gain, the first $1 million of capital gain from being taxed. Okay, so a married couple, you'd have $2 million. So it'd still shelter many, many, many people. But basically, if you inherited, let's take that example, okay? You inherited an account from someone where they originally had $300,000 of basis, and it's worth $500,000. So you inherit it from them, and now your cost basis goes up to $500, presto. And you could sell it all at that time, or you could continue holding it. Under these new rules, that $200,000, that $500,000, even if you didn't sell anything, there would be a capital gain realized on that deceased person's last tax return or on their estate tax return. There would be a capital gain realized of $200,000. The gain between the deceased person's $300,000 basis and the $500,000 value at the date of death. And there'd be $200,000 of realized gain, and that would go against someone's exemption, which right now they're saying would be $1 million exemption. So in that case, it wouldn't be taxable. There'd be some extra reporting work, extra tax filing work, but it wouldn't be taxable, and the new person would inherit it, and it would still have a high basis of $500,000 because it's effectively sold or it'd be realized during that point, okay? Say though, for example, you're talking $1 million cost basis and 1.5 million, or excuse me, 500,000 cost basis and 1.5 million market value, okay? Even if you inherited that, and even if the person didn't sell those investments, that gain would need to be realized on a tax return. It would land on a tax return that here's my long-term gain and would go against the exemption. So thankfully, they're saying that each person would get $1 million exemption from this tax, and that the 500,000 or 250 and 500,000 primary residence homeowners capital gain or gain exclusion would also apply at the date of death as well. So they've made the tax code, if this thing passes, much more complicated, still sheltering and making it so that the old rules would still apply for most of us, but creating a potential big tax surprise or tax burden for those folks that don't quite meet all of those criteria. So what should you do about this? Do you rush out right now and say, all right, well, I got to start changing some things, gifting some dollars, selling some things, or changing my overall tax strategy? No, I would tell you not to make any changes right now. Number one, this is a proposal. It's a bill. It is not law yet. The infrastructure plan was the stimulus that was already announced before this one. That one's having a hard time getting passed in its original form, okay? And likely, this plan, the American Families Plan, will face an uphill battle with Republicans and even Democrats to get passed in its current form. I think there are components that each side of the aisle do not like and will want to change. So I would tell you, don't go out and make some drastic changes right now. Work with your certified financial planner to say, if this thing passes, what will the ramifications be? Okay? So just plan right now, don't take action. That's one. The second, though, is make sure that you're funding all of the appropriate tax-sheltered accounts. This doesn't apply to you if you're funding 401ks, Roth IRAs, and that sort of stuff. This only applies to you if you're funding accounts that are other than that. So don't fund other accounts if you still can contribute more to these tax shelters, okay, where these rules don't apply. So work with your certified financial planner, make sure you're funding the right accounts. If you don't have a CFP on your team, you can always contact one on my team. Find us online, corehorn.com, that's Corehorn with a K, wisemoneyshow.com, you can find us there too, or send us an email, info@corehorn.com. All right, there you have it. Go out and take your next wise step in your financial life.